Good morning. Today we are initiating coverage on the advanced semiconductor packaging and silicon photonics subsector, the critical and often misunderstood backbone of the global artificial intelligence infrastructure build-out. While retail markets have aggressively bid up pure-play fabless GPU designers, institutional capital is recognizing that compute power is inherently bottlenecked by memory proximity and data transfer rates. The transition from monolithic semiconductor dies to chiplet architectures, utilizing chip-on-wafer-on-substrate, or CoWoS, has created a definitive choke point in AI accelerator supply chains. Our quantitative modeling suggests the total addressable market for advanced packaging will compound at a highly elevated rate, exceeding $45 billion by fiscal year 2028. We view this as a structural mispricing. This report outlines our overweight thesis based on robust margin expansion, impenetrable supply chain moats, and compressed valuation multiples relative to the broader AI hardware complex.
Analyzing the macroeconomic dynamics, we observe a paradigm shift in Moore's law. Traditional node shrinkage is demonstrating diminishing marginal returns, forcing foundries to adopt lateral and vertical scaling. Advanced packaging techniques, specifically CoWoS, have experienced a demand surge outstripping current supply run rates by approximately 30%. Tier 1 hyperscalers deploying next-generation architectures are strictly dependent on these advanced interconnects to maximize teraflops per watt. Consequently, we are tracking a massive reallocation of top-tier foundry capital expenditures away from trailing-edge logic and directly into back-end packaging capacity. Our supply chain checks indicate order backlogs extending well into late 2025, providing exceptional revenue visibility for the dominant players in this oligopoly.
Compute power is functionally irrelevant without sufficient memory bandwidth to feed the processors. This brings us to high bandwidth memory, or HBM, the secondary engine powering the AI explosion. The industry is currently facing a memory wall where data transfer speeds lag behind processing capabilities. This constraint is solved via vertical stacking of DRAM dies connected by through-silicon vias. Currently, HBM3E average selling prices are carrying a structural 5x premium over standard commodity DRAM. With only two major suppliers currently controlling 90% of global HBM supply, we forecast operating margins for these memory fabricators to expand by roughly 450 basis points over the next 8 quarters due to this favorable mix shift. Turning to quantitative revenue projections, our models indicate an aggressive upward trajectory. We project a sector revenue compound annual growth rate of 28.5% through 2028. Furthermore, the proliferation of custom silicon designed by hyperscalers like AWS, Google, and Meta is expected to drive 40% of the future total addressable market. The traditional data center capital expenditure cycle has definitively shifted from CPU-centric upgrades to AI-optimized accelerated server racks. Simultaneously, we are modeling the silicon photonics market, which relies on light rather than electrical signals for data transfer, to scale rapidly from $1.2 billion to $4.8 billion, acting as a secondary growth vector for the packaging sector.
Let us examine the balance sheet implications and unit economics. The intense capital requirements to develop advanced packaging facilities create impenetrable economic moats. Because the technological barrier to entry is so severe, incumbent players possess immense pricing power, resulting in gross margins structurally elevated above 55%. While research and development as a percentage of revenue is stabilizing around 14%, the capital expenditure velocity remains high. However, our discounted cash flow models suggest that once the peak capacity expansions are completed in 2025, we will see an accelerated phase of free cash flow generation. This inflection point is currently underappreciated by the sell-side consensus.
From a valuation standpoint, we believe the advanced packaging and HBM cohort is trading at a structural discount. The sector is currently trading at a blended multiple of 18 times enterprise value to EBITDA. Contrast this with pure-play AI semiconductor designers, which are clearing 35 times EBITDA in the open market. Forward price-to-earnings multiples have artificially compressed due to overly conservative management guidance regarding yield rates. Furthermore, adjusting for price-to-earnings to growth, or PEG ratios, these infrastructure plays offer a deep discount relative to the hyperscaler growth curve. we project a highly attractive free cash flow yield of 4.2% for fiscal year 2025, providing a robust margin of safety. The structural advantage in this subsector lies in the severe oligopolistic nature of the supply chain. The top 3 players currently command 85% of the global market share in advanced back-end logic packaging. The equipment lead times required to challenge these incumbents extend well beyond 52 weeks, effectively nullifying the threat of disruptive new entrants in the near term. Furthermore, fabless semiconductor designers face prohibitively high switching costs. Redesigning a chiplet architecture for a new packaging vendor requires millions in non-recurring engineering costs. This vertical integration and high customer lock-in provides superior pricing power and exceptional visibility into future earnings quality. As institutional fiduciaries, we must responsibly model downside risks. Our bear case centers on 3 primary friction points. First, yield rate degradation. The 3D stacking processes inherent in HBM and CoWoS are notoriously difficult. Any regression in yield rates will immediately compress gross margins and disrupt hyperscaler delivery schedules. Second, we are monitoring the potential for double ordering. Panic buying by data centers could create an artificial backlog bloat, leading to an eventual inventory correction. Finally, there is a distinct risk of hyperscaler capex fatigue post-2026. If the monetization of large language models fails to offset the tremendous infrastructure costs, enterprise AI hardware budgets will contract, severely impacting back-end volume. Conversely, our bull case relies on total addressable market expansion migrating aggressively beyond core hyperscaler data centers. We are modeling significant upside driven by sovereign AI initiatives, where nation-states develop parallel, localized AI supply chains for data sovereignty, creating unoptimized, redundant demand for packaging infrastructure. Additionally, the transition to edge AI inferencing will require highly specialized, low-power, advanced packaging solutions localized on consumer and industrial hardware. As application-specific integrated circuits, or ASICs, proliferate across automotive and robotics sectors, outsourced semiconductor assembly and test volume will surge. Under these conditions, we see the potential for upward earnings revisions of up to 20% above consensus for fiscal year 2025. To summarize our thesis, the market has fundamentally mispriced the infrastructure required to sustain the AI explosion. Advanced packaging and high-bandwidth memory represent the true physical bottlenecks of the current technological cycle. We are issuing an overweight rating on Tier 1 advanced packaging and HBM suppliers. Our base case quantitative model implies a 32% upside over a 12-month horizon, driven by multiple expansion and earnings beats. The key near-term catalyst will be the Q3 hyperscaler capital expenditure reports, which we anticipate will confirm sustained back-end infrastructure investment. Given the structural moats and current EV to EBITDA discounts, we conclude the risk-reward profile remains highly asymmetric in favor of long positions.